We are now ready to take a look at the different types of adjusting entries that a company might have to make at the end of the accounting period. We're going to focus now on prepared adjusting entries for deferrals. When you think about the accounting period, it is broken down into some type of economic life cycle. When you think about your place of employment, maybe you're paid weekly, bi-weekly, once a month, or you have to prepare reports for your employer on a monthly basis. But pretty much everything we do in accounting is based upon time. So we have to break down accounting information into some type of time interview. The fiscal year of a company would be a 12-month time period, and sometimes reports are prepared even on a more frequent basis. So generally, we're looking at a month, a quarter, or a year as the time period assumption. And at the end of these different time periods, we have to make what's known as different types of adjusting entries. So you think about a fiscal year, that refers to any 12 months chosen as the accounting period of a business organization. Those 12 months could be a calendar year, January through December, or it could run from March 1st of one year to the end of February for the upcoming year. If you are a public corporation, you're required to prepare annual financial statements that are seen by those inside and outside the company, as well as quarterly statements that are submitted to the Securities and Exchange Commission. Now, we discussed in our first video, we have what's called the accrual-based accounting system. I want to compare the accrual basis to the cash basis of accounting system. With the accrual-based accounting system, it is an accounting system where we are going to recognize and record revenue when the transaction has occurred. So on the accrual basis, the accounting rule says recognize revenue when you have performed a service or when you have sold the actual product. It says record your expenses as they are incurred. It's not contingent upon whether we pay for the expense or not, or whether the client has paid us. The question is, have we provided the service? If so, recognize the revenue. Has the expense incurred? If so, recognize and record the expense. In contrast, the cash basis is based upon an actual cash transaction taking place. Under the cash basis of accounting, we recognize revenue only once cash has been received and record expenses only once cash has been paid out. Now, if you are a sole proprietorship, you may use the cash basis for your accounting system. But if you are a public corporation, which means you trade stock publicly, you must use the accrual basis when recording your business transaction. The cash basis is not in accordance with generally accepted accounting principles. Therefore, the cash basis is not approved for public corporation. These corporations must use GAAP principles when recording their business transaction. We have a principle called the revenue recognition principle, which pretty much says to recognize revenue once the performance obligation has been satisfied. Where pretty much how do we do this? Typically by either performing some type of service for an actual client or selling them an actual product. So once the performance obligation is satisfied, at that point in time, we can recognize and record the revenue transaction. The expense principle says any expenses that took place in order to earn the revenue should be recorded in the same accounting period. Again, any expenses that incurred in order to earn revenue, record those expenses in the same accounting period. Because of these two principles, we have to make adjusting entry at the end of the accounting period to make sure that all revenue earned has been recorded and that all expenses incurred have been recognized as well. So again, because of these principles, we have to make these adjusting entries at the end of the accounting period. We also want to make sure that every account has been updated before we prepare our statements at the end of the accounting period. So without these adjusting entries, our statements would not be accurate financial statements because it would not consist of all of our revenues and all of our expense accounts. So it is very important that companies make these adjusting entries required at the end of their accounting period. Remember we said before, when you're making adjusting entries, it's going to impact at least one account from the income statement and at least one account from the balance sheet. We're going to focus on today what's called deferral adjusting entries, prepaid expenses, and unearned revenue. We'll cover these later. Prepaid expenses are expenses paid in cash before they are used or consumed. Unearned revenue refers to cash received before services are performed. We're going to focus on adjustments for prepaid expenses and adjustments for unearned revenue. So let's begin looking at examples of prepaid expenses. If you paid your rent for 6 months in advance, or if you paid your insurance in advance, that's known as a prepaid expense. It is an expense paid for before it is actually due. In other words, the cash payment is made before the expense has been recorded. So initially what we do, prepaid expenses are recorded as assets in our accounting records. But we then have to make an adjusting entry at the end of the accounting period to show what portion of the prepaid expense has been used or consumed by the end of the accounting period. So initially, the prepaid expense is recorded into an asset account. But at the end of the accounting period, we're going to make an adjustment. We're going to show what portion has been used up. And at that time, we're going to credit the asset account for the amount that's been used and also recognize an expense. Let's get into it. Pioneer Advertising purchased supplies costing $2,500 on October the 5th. They recorded it by debiting supplies account, which is an asset. An inventory account at the end of October 31st reveals that 1,000 of supplies are on hand. So initially we bought supplies and we paid $2,500. At the end of the accounting period, we have supplies remaining in the amount of $1,000. Therefore, our supplies have been used during the course of the accounting period. Once supplies have been used, that cost now becomes an expense. So ask the question, supplies decreased by how much? You're correct, $1,500. The portion that was used now becomes an expense. So we're going to make an adjusting entry on October 31st. We'll debit supply expense for $1,500, credit supplies for $1,500. The adjustment is to recognize what portion of supplies that have been used to decrease the account and to recognize our supplies expense. So here you have the two ledger account for supplies and supplies expense. Supplies initially showed for $2,500. Here you see the decrease for the $1,500. Our new supplies balance after adjustment is now going to be $1,000. Okay. Next up, on October 4th, we pay an advertising company $600 for a 1-year fire insurance policy. I'm sorry, so Pioneer Advertising Inc. pays $600 for a 1-year fire insurance policy. Coverage begins on October 1st. On October the 1st, we debit an account called Prepaid Insurance in the amount of $600. Now, at the end of October, we have to make an adjustment. The adjustment says what portion of the prepaid insurance has been used by the end of the accounting period. So let's look at the illustration over here. The insurance covers a total of 12 months. We're now at the end of the first month. So if you look at the amount that was paid, $600, the insurance amount is going to be $50 per month. We're going to make an adjusting entry to recognize the amount of insurance that has been used by the end of the current accounting period. We're going to debit insurance expense for $50 and credit our prepaid insurance account. Okay, so we make the adjustment to the prepaid insurance account. We're showing the initial amount of $600, the adjustment for $50. The balance in the prepaid insurance account would be $550 at the end of the accounting period. And in our insurance expense ledger account, we're showing the $50 for the adjustment made at the end of the accounting period. Okay, so I think I'm going to stop right there, and I'm going to create a second video that will cover unearned revenue and the other types of adjustments.